His name is Marcus. He is 34 years old, and he is about to make the smallest trade of his life. Not small because his account is small, not small because the setup is weak or the conviction is low. Small because after 18 months of trying everything else, after courses and strategies and mentors and communities and indicator packages and risk management frameworks, he has finally, reluctantly, run out of other options. He has decided to trade 1/10 of his normal position size. He has been trading standard lots. Today, he is going to trade a micro lot. The difference in dollar terms is the difference between risking $150 per trade and risking $15 on an account that started at $12,000. It feels absurd. It feels like giving up. It feels like the financial equivalent of driving on the motorway at 20 miles an hour because you once had an accident. It feels, if he is being honest with himself, like something a person does when they have accepted that they are never going to be a real trader. He takes the trade anyway. And then something happens that Marcus will spend the next 3 months trying to understand. The trade plays out almost exactly as his analysis said it would. He holds it to the target. He does not move the stop. He does not close it early at 30% of the profit because the fear of giving it back became unbearable. He does not second-guess the entry the moment price moves 3 pips against him. He just trades it, cleanly, the way his system was designed to be traded, the way he trades it in his head when he is analyzing charts on a Sunday and nothing real is at stake. He made $11. $11 on a trade that at his normal size would have made $110. And sitting at his desk after that trade, looking at the $11 profit, Marcus felt something he had not felt after a winning trade in a very long time. He felt nothing. Not disappointment, not excitement, not relief. Nothing. Just the quiet, neutral acknowledgement that the trade had worked and the system had been followed and the session was over. He did not understand yet why that feeling, or the absence of feeling, was the most important thing that had happened to his trading in 18 months. He did not understand yet that the size of the position had been the variable controlling his psychology all along, not his strategy, not his discipline, not his knowledge. He did not understand yet that the Stoic philosophers had a name for what he had just accidentally discovered, and that they had considered it the foundation of everything else. He would understand, and by the end of this video, so will you.
The trading industry teaches position sizing as a risk management concept. You risk a percentage of your account per trade, typically 1 to 2%, and this keeps any single loss from doing serious damage to your capital. The mathematics of this are sound, the logic is correct, and it completely misses the most important thing that position size actually does. Position size does not just determine how much money you can lose on a trade. It determines who you are while you are in the trade. Think about what happens to a trader psychologically as position size increases. At very small size, the size where the dollar outcome of the trade is genuinely irrelevant to the trader's financial life, the trader behaves almost identically to how they behave in a demo account or a backtest. They follow the system. They hold the trade. They let the stop do its job. They take the target when it is reached. The emotional temperature of the trade is low, and low emotional temperature produces clean execution. Now increase the size, not dramatically, just to the point where the outcome of the trade begins to feel meaningful, where a loss would be noticed, where a win would produce a visible change in the account balance. Something shifts. The trader is still using the same system, the same entry criteria, the same stop-loss level, the same target, but they are watching the trade differently. The slight adverse movement that they ignored at small size now produces a tightening in the chest. The trade that is moving in their direction now generates the fear of giving it back. The decision to hold to the target or close early is no longer made by the system. It is made by the emotional state of the person watching the numbers move. Increase the size further, to the level where a loss would genuinely hurt, where a sequence of losses would do serious damage, where the outcome of this trade has real consequences for this month's finances, and the transformation is complete. The trader is no longer executing a system. They are managing their own anxiety. They are making decisions about the trade based not on what the price action is doing, but on what they can emotionally tolerate watching happen to their account. This is not weakness. This is not a character flaw. This is the predictable, documented, universal response of the human nervous system to financial threat. When the size is large enough to feel threatening, the primitive parts of the brain responsible for threat response take partial control of decision-making. And those parts of the brain were not designed to trade the Forex market. They were designed to survive the savannah. Their priorities are immediate threat elimination, not system adherence over a large sample of trades. In 2011, a study of retail trading accounts found that traders who reduced their position size following a losing streak not just reduced their losses on subsequent trades, they traded better. Their entries were more selective, their stop adherence improved, their average risk to reward on taken trades increased. The researchers initially assumed this was because smaller size reduced the financial pressure of loss, but a closer examination revealed something more precise. Smaller size reduced the emotional activation of the trades enough that the traders' decision-making shifted from reactive to deliberate. They stopped managing their feelings and started executing their systems. Marcus experienced this in $11. He did not design the experiment. He stumbled into it out of exhaustion. But what he found was the same thing the research found, the same thing every consistently profitable trader eventually discovers, and the same thing that Epictetus, a man who spent the first half of his life as a slave and owned nothing at all, had articulated with perfect clarity almost 2,000 years before the first trading platform was built. The size of what you stand to lose determines whether you are thinking or reacting. And a trader who is reacting is not trading their system. They are trading their fear. Epictetus was born into slavery in the city of Hierapolis in what is now Western Turkey around 50 AD. His name was not even his own. Epictetus is a Greek word meaning simply acquired or bought. It was not a name he was given. It was a description of his status. He was brought to Rome as property of a man named Epictetus, who himself was a freedman and secretary to the Emperor Nero. Epictetus was permitted to study philosophy under a Stoic teacher named Musonius Rufus, and what he encountered in that philosophy changed the entire orientation of his life, not by changing his external circumstances, which remained those of a slave, but by transforming his understanding of what was actually his to lose. The central insight of Epictetus's philosophy, the idea he returned to in every lecture, in every conversation, in every line of the discourses that his student Arian recorded, was the dichotomy of control, the absolute, non-negotiable division of all things into two categories, what is within your power and what is not. Within your power, your judgments, your intentions, your desires, your responses to events, your opinion of what happens to you, the choice you make when the market moves against your position. Outside your power, everything else, your body, your reputation, the price of the euro-dollar, whether your stop gets hit, whether the trade reaches your target, the news that drops at 2 in the afternoon, the central bank decision, other traders, the algorithm, all of it, outside your power, completely and permanently beyond your control. Epictetus said that the source of all human suffering was the confusion of these two categories, the attempt to control what cannot be controlled, the attachment of your well-being to outcomes that the world, not you, will determine.
He wrote,
Men are disturbed not by the things which happen, but by the opinions about the things. For example, death is nothing terrible, for if it were, it would have seemed so to Socrates. For the opinion about death that it is terrible is the terrible thing. Death is not terrible. The opinion that death is terrible is terrible. The event is neutral. The judgment applied to the event is what produces the suffering. Now apply this directly to a trade that is moving against you. The trade going into the red is not in itself a threat. It is a series of price movements in a market that has no awareness of your existence. What makes it feel threatening is the judgment applied to it, specifically the judgment that this loss means something that cannot be tolerated, that this loss is large enough to matter, that this loss must be avoided or recovered or denied. And the judgment that a loss cannot be tolerated is produced almost entirely by one variable, the size of the position. At size Marcus was trading before he reduced, the size where a loss genuinely hurt, where a bad week changed the month's finances, the loss could not be tolerated. Not because Marcus was weak, because the size had made the loss genuinely significant. The opinion that the loss was threatening was not irrational, it was an accurate response to a real threat that Marcus himself had created by choosing that size. At micro-lot size, the loss was $11. The opinion that $11 was a threat was not available to Marcus's nervous system, because $11 is not a threat. And without the opinion of threat, the dichotomy of control became accessible in a way it had never been at full size. The price movements were outside his control, his execution was within it, and for the first time in 18 months he traded from that distinction rather than despite it. Epictetus did not teach philosophy as theory, he taught it as practice, as the daily deliberate training of attention toward what is within your power and away from what is not. And the most direct application of that training to trading is this: choose a position size that makes the outcome of the trade psychologically irrelevant. Not financially irrelevant, you still want real money on the line because the absence of stakes removes the training value. Psychologically irrelevant. Small enough that losing does not activate the threat response. Small enough that winning does not produce euphoria. Small enough that the price action is information rather than danger. At that size, you are no longer managing your fear, you are trading your system, and trading your system is the only thing that actually works. Let me be precise about this, because trade smaller is advice that gets dismissed immediately by most traders, not because it is wrong, but because it sounds like a consolation, like something you say to someone who cannot handle the real game. I want to show you exactly what small size does to the mechanics of your trading, specifically and concretely, so that the advice stops sounding like retreat and starts sounding like strategy. The first effect, it fixes your entries. When position size is high, entries become contaminated by the size itself. The trader who is about to risk $150 on a trade does not evaluate the setup with the same detachment as the trader who is about to risk $15. The larger the stake, the more the mind looks for confirmation, the more it rounds up borderline setups into valid ones, the more it interprets ambiguous price action in the direction of the trade it already wants to take. This is confirmation bias amplified by financial stake. It is not a conscious process. The trader genuinely believes they are evaluating the setup objectively, but the evaluation is happening in a brain that is already partially activated by the size of what is at risk, and that activation subtly distorts the analysis toward the conclusion that justifies the trade being taken. At micro-lot size, this distortion largely disappears. The trade is evaluated on its own merits because the outcome is not significant enough to bias the evaluation. Entries become more selective, more honest, and more aligned with the actual criteria of the system. The journal begins to show what the system actually looks like when it is traded without the interference of a nervous system protecting itself from a significant financial outcome. Marcus noticed this in the third week after he reduced. He was taking fewer trades, not because he was being more conservative, because the setups that previously almost met his criteria no longer looked the same. At full size, almost was close enough. At micro size, almost was obviously not there. The financial irrelevance of the outcome had removed the pressure to find a trade, and without that pressure, his entry standards quietly returned to what they had been in his backtests.
The second effect, it fixes your stop loss. The stop loss is the most violated rule in retail trading, not because traders do not know the rule, because at significant position size, the rule becomes emotionally impossible to follow. When a stop loss is hit at full size, it is not just a number that changes on a screen. It is the experience of loss, real, immediate, felt in the body. And the human response to the anticipation of that experience is to prevent it, to move the stop, to give the trade a little more room, to convince yourself that the level was not quite right and that a few more pips of space will allow the trade to recover. To do anything, in short, that delays the moment of confirmed loss. At small size, the stop loss becomes mechanical. When it is hit, the loss is $11 or $7 or $23. The emotional cost of accepting that loss is low enough that the rule can be followed without the kind of internal struggle that full size produces. The stop is just a stop. It does the job it was designed to do, and the trader who follows their stop consistently, who does not move it, does not widen it, does not override it, has an entirely different risk profile to the trader who treats it as a negotiable guideline under pressure. Epictetus said, "First say to yourself what you would be, and then do what you have to do." The stop loss is what you decided you would be before the trade opened, a trader who accepts this specific loss if the thesis is wrong. Small size is what makes it possible to actually be that trader when the moment arrives. The third effect, it fixes your exits on winners. The mirror image of the stop loss problem is the problem of early exits on winning trades, and it is produced by exactly the same mechanism. When a trade is significantly in profit at full size, the open profit becomes something the trader feels they own. It is real money, not yet realized but visible on the screen, and the brain processes visible money as already possessed. The prospect of watching that money disappear as price reverses is experienced as loss, the loss of something already owned, and loss aversion kicks in with full force. The result is the early exit. The trade that was planned to run to 140 pips is closed at 60 because the profit feels too real and too at risk to hold. The trader books a win, feels the relief of having locked in the gain, and then watches price continue to the original target. The system worked, the trader did not. At small size, the open profit on a winning trade does not feel like owned money in the same way. $47 on the screen does not produce the same possessive attachment as 470. The trade can be held to the target because the fear of losing the open profit is not strong enough to override the system. The trade runs, the full risk to reward is captured, and over a large sample of trades, capturing the full risk to reward instead of 50 or 60% of it is the difference between a profitable system and a break-even one. The fourth effect, it builds the template. This is the effect that Marcus did not anticipate and that took him longest to understand, but it is the most important. Every trade taken at small size is a rehearsal, a dress rehearsal for the same trade at full size, conducted under conditions close enough to real for training value, but with the emotional stakes reduced enough that clean execution is possible. And clean execution, repeated consistently over dozens and then hundreds of trades, does something to the nervous system that conscious discipline alone cannot do. It builds a template, a physical, practiced, repeated pattern of behavior that the body begins to recognize as the correct response to a trade. Entry, management, exit. Follow the system, honor the stop, hold to the target. Done. Next trade. When Marcus eventually returns to full size, not because he decided it was time, but because the small size trades had become so unremarkable, so mechanical, so emotionally neutral that the system was simply running without interference, he will bring the template with him. The nervous system that has executed this trade cleanly 140 times at $15 per pip does not forget that pattern when the size becomes 150. It is not automatic and it is not permanent. The emotional pressure of full size will still be felt, but the template is there. The practiced response is available in a way it was not before. And that availability is the difference between a trader who knows what to do and a trader who actually does it. Everything I have described so far is diagnosis. The three practices I want to give you now are the treatment. Each one is drawn directly from Epictetan philosophy, and each one uses position size not as a risk management calculation, but as a deliberate psychological instrument.
Practice 1. The Emotional Threshold Test. Before your next session, sit down and answer one honest question. At what position size do I begin to feel the trade? Not feel in the sense of intellectual awareness, feel in the sense of physical sensation, the tightening in the chest when the trade moves against you, the elevated attention when it moves in your favor, the discomfort of watching the stop-loss being approached, the point at which the trade is no longer just a position in a market, but something that has crossed the threshold into emotional significance. That threshold is your number. Write it down. It is the most important number in your trading, and almost nobody knows what it is. Now halve it. Trade at half that size for the next 30 trading sessions, not as punishment, not as a sign that you cannot handle the real game, as the deliberate creation of emotional space, the space in which your system can run without the interference of a nervous system that has been activated into threat response. Epictetus taught that freedom was not the absence of constraint, but the correct relationship between desire and what is within your power. Trading at half your emotional threshold is the practice of creating the conditions under which your power over your own execution is actually accessible. It is freedom from the tyranny of a position size that has given the market's movements power over your decision-making. 30 sessions. Track your stop-loss adherence, your entry quality, your exit accuracy. Compare those numbers to the 30 sessions before. The data will tell you everything you need to know about what size was doing to your trading. Practice 2. The Scaling Protocol. This practice addresses the question that every trader asks when they hear the advice to trade smaller. When do I go back to full size? The answer is not a time-based answer, it is a performance-based answer. And the criteria are drawn directly from Epictetus's concept of the progressing student, the person who has not yet arrived at wisdom, but who is genuinely moving toward it through consistent practice. You are ready to increase your size when 3 conditions are met simultaneously over a minimum sample of 50 trades. Condition 1, your stop-loss adherence is 100%, not 90%, not 98%. Every planned stop has been honored exactly as written before the trade opened. No moves, no wides, no just a little more room. 100%. Condition 2, your exit accuracy is above 80%, meaning that on trades which reached their target, you closed at the target or beyond it, not early, not at 60% of the move because the profit felt too good to risk. 80% of winning trades captured in full. Condition 3, your entry quality, assessed honestly against your written criteria, shows fewer than 10% of trades involving any deviation from the setup requirements. No almost setups, no close enough. The entry was there or it was not. When all 3 conditions are met across 50 trades, you increase your size by 25%. Not double, not back to full size in one step, 25%. And the 3 conditions reset. They must be met again at the new size before the next increment. This protocol is slow. It will feel slow. The trader who started with a $12,000 account trading microlots will take months to return to standard size through this progression. That is correct. The timeline is not a limitation, it is the training. Each increment of size is a new test of whether the template built at the previous size holds under slightly greater emotional pressure. And each time it holds, the template becomes more durable. Practice 3, the premeditation of size. This practice is a direct adaptation of the Stoic exercise of premeditation malorum, the premeditation of difficulties, applied specifically to the question of size. Before every session, before the charts open, you sit with your planned position size and you run through a specific mental exercise. You imagine the trade losing, not vaguely, specifically. You see the price moving to your stop level. You watch the loss register at the exact dollar amount your planned size will produce. You feel, as honestly as you can in a non-live context, what that loss will feel like. Then you ask yourself one question. If this trade loses exactly this amount, will I be able to close it at the stop without hesitation, record it in my journal without self-punishment, and come back to the screen tomorrow with the same preparation and the same rules? If the honest answer is yes, if the imagined loss is genuinely acceptable, genuinely absorbable, genuinely small enough that it will not activate the threat response or trigger the cascade of emotional decisions that follow a loss that feels too large, then the size is correct. Take the trade. If any part of the honest answer is hesitation, if the imagined loss produces a tightening, a reluctance, a sense that this amount is more than you are truly comfortable losing on a single trade, reduce the size until the answer becomes yes. Not until the hesitation disappears entirely, because a small amount of healthy respect for risk is appropriate and useful. Until the imagined loss sits within the range of what you can absorb cleanly, execute cleanly, and move on from cleanly. Epictetus wrote, "Seek not that the things which happen should happen as you wish, but wish the things which happen to be as they are, and you will have a tranquil flow of life." The premeditation of size is the practice of wishing in advance that the loss, if it comes, will be exactly what it is, not fought, not denied, not reversed through revenge trading, just accepted, recorded, and released. And the only size at which that acceptance is genuinely available is the size where the loss does not feel threatening. Find that size, trade it, and build from there.
Let me tell you where Marcus is now. He's been trading micro lots for 11 weeks. His account has not grown dramatically. In dollar terms, the gains are modest, the kind of numbers that would look unimpressive on a trading forum.
the kind that are invisible next to the screenshots of four-figure weekly profits that circulate in the communities he used to follow. But something else has happened that does not show up in the dollar figures. Marcus has not moved a single stop-loss in 11 weeks, not once. He has taken 17 losses in that period, every one of them at the planned level, every one of them recorded in his journal within 2 minutes of the trade closing. He has held 12 winning trades to their targets. 2 of them he held past their initial targets because the price action told him the move was continuing, and his system had a rule for that situation, and at micro size he was calm enough to actually apply the rule instead of closing at the first number that felt safe. His system, the same system he has had for 18 months, the same system that was profitable in backtests and inconsistent in live trading, is producing results that look like the backtest for the first time. Not because the system changed, because the person executing it changed, because the size changed what kind of person was sitting at the desk. He does not feel like a serious trader. The $11 wins do not feel like the trading career he imagined when he started. The gap between where he is and where he wants to be is still real and still significant, and he is still aware of it every time he opens his journal. But he is aware of something else now too, something that 18 months of full-size trading never gave him. He knows what his system actually does, not what it does in a backtest where the decisions are frictionless and the emotions are absent. What it does in the hands of a specific human being with a specific nervous system in the specific conditions of a live market with real money at stake. He knows his entry accuracy. He knows his stop adherence. He knows what his exits actually looked like versus what his plans said they would look like. He has a true picture of his trading, collected at a size where the picture was not distorted by the emotional pressure of stakes that were too high. Epictetus was born with nothing and owned nothing and spent years as the property of another person. And from that position, from the complete absence of external resources, the total inability to control his circumstances, he built a philosophy that the most powerful men in Rome studied and that has survived intact for 2,000 years. His central teaching was not about wealth or power or ambition. It was about the correct relationship between what you control and what you do not, between what is yours and what belongs to the world. The price of the euro-dollar is not yours. The outcome of the trade is not yours. Whether the stop gets hit or the target gets reached, none of it is yours. Your execution is yours. Your entries, your stop adherence, your exits, your process, those belong to you. And the only way to actually own them, the only way to trade them with the clarity and consistency that profitable trading requires, is to trade at a size where the market's movements do not have the power to take them from you. Trade small enough that you can think. Build from there. I will see you in the next one. Seek not that the things which happen should happen as you wish, but wish the things which happen to be as they are, and you will have a tranquil flow of life. Epictetus.